Trend continuation, the two-zone rule every trader should know. If you're trying to catch every reversal, you're probably catching more losses than wins. Most traders lose money fighting trends that were never actually done. Today, I'm giving you a simple filter that tells you when a trend is still in control before you try to fight it. Here's the problem. Price breaks a zone and your instinct says reversal, so you jump in against the trend. Sometimes that works, but most of the time, that broken zone was just a pullback inside a trend that's still very much alive. You end up on the wrong side, wondering why the obvious reversal never happened. The fix isn't a new indicator, it's reading the zones that are already on your chart differently. Quick reminder of what we covered last video. A demand zone forms where buyers stepped in hard, a supply zone forms where sellers stepped in hard. Price tends to return to these zones because that's where the unfilled institutional orders are sitting. That part doesn't change here. What changes is what we do when a zone gets broken. Here's the filter. In a downtrend, watch what happens when price rallies back up into a demand zone and breaks through it. On its own, that's not enough information. But if price drops, rallies into a second demand zone and breaks through that one too, that's confirmation. Two demand zones broken in a row on the intermediate time frame means sellers are still firmly in control and the downtrend is continuing, not reversing. Picture it. Price drops into zone 1, forms a base, rallies weakly, and breaks straight through. Then it drops further, forms another base at zone 2, rallies again, and breaks through that one too. Every one of those broken zones is a vote that says sellers are still here. The exact same logic works in reverse for an uptrend. Price pulls back into a supply zone and breaks through it going up. Then it pulls back into a second supply zone and breaks through that one too. Two supply zones broken confirms buyers are still in control, and the uptrend keeps going. Now, here's where people get burned. One broken zone by itself is common inside a completely healthy trend. Strong trends punch through zones all the time without reversing. That's actually a sign of strength, not weakness. If you treat every single broken zone as a reversal signal, you'll get chopped up entering countertrend trades again and again. Two zones broken in the same direction is a different story. That's not a one-off. That's a repeating structural signal, and structure is what you want to trade off of, not a single reaction. So what do you do with this in real time? First, if you're already in a countertrend trade and a second zone breaks against you, that's your signal to get out. Don't wait for a third. Second, once you get that second zone break confirming continuation, you can look for an entry in the direction of the trend itself. Wait for price to form a fresh zone after that second break and treat that fresh zone as your new continuation entry, with your stop on the other side of that zone and your target toward the next area of liquidity. This turns a filter into an actual trade plan. You're not just avoiding bad reversal trades anymore. You're using the same information to find good continuation trades. One more thing, this rule tells you about probability, not certainty. Nothing in trading is guaranteed. Always size your position so that being wrong doesn't put a dent in your account, because eventually even a two-zone continuation signal will fail. That's not the rule breaking, that's just risk. Respect it every single time. Let's recap. One broken zone is common noise inside a trend. Two broken zones in the same direction is structure, and structure is your confirmation that the trend is continuing. Use that to stay out of bad counter-trend trades and to find good continuation entries instead. If this helped, subscribe. Next video, I'm going deeper into exactly how I size and manage risk on continuation entries like this one.
Live chart walkthrough, 7:15. Let's walk through this on an actual chart. Say we're on Euro USD, 4-hour time frame, and we're already in a clear downtrend. Price rallies up into a demand zone sitting around 1.0850. It pauses there for a couple of candles, then breaks straight through, dropping toward 1.0790. That's zone 1 broken. Noted, but not enough on its own. Price keeps falling, then rallies again into a second demand zone around 1.0740. Same story, a brief pause, then it breaks through that zone too, continuing down toward 1.0680. That's it. That's your two-zone confirmation. Sellers took two shots at defending demand and failed both times. At this point, if you were long from that first zone hoping for a reversal, you're out. And if you're looking to trade with the trend, you're now watching for the next fresh zone to form on the way down. That becomes your continuation entry. Stop above the zone, target toward the next area of liquidity below. That's the whole process, from "is this trend still alive" to an actual entry, using nothing but the zones you already know how to draw.